Well, the US exceptionalism story is no longer as bulletproof as it was 18 to 24 months ago, with earnings broadening out and valuations offshore looking increasingly attractive, making diversification a far more compelling proposition. At least that is the thought from Marc Wait from Providence Wealth Advisory, and he joins us now. Marc, welcome.
Thanks, Andrew.
So what do you make of those valuations there? I mean, you have a potentially bullish outlook, but that's selective.
Selectively bullish is our sort of theme for the moment, and that's very much sort of built on, I think there's a narrative around that markets in general are expensive, but I think we would say which market. And so when you have a look around the world, we think there's some very interesting opportunities outside of the US. And so in terms of our sort of global equity exposure, we've got some exposure into the US, but we've really sort of lent into some other markets. And the other markets that we've lent into have been emerging market equities. And so if you think about that asset class, it's been a very difficult sort of long-term period. Japanese equities, there's also been sort of animal spirits stirring in Japan, particularly with the sort of stage 2 of Abenomics with the new Prime Minister. And then also we think sort of global mid-caps is an asset class that's got quite an interesting opportunity to perform. And all of these asset classes, what's really changed is when you look at earnings expectations are now pretty similar to what you're seeing in the US, yet you're paying a substantially lower price to earnings ratio to buy each of those markets. So if you look at emerging markets, it's in the high 13s versus the S&P 500 at 22 times. If you look at the sort of Japanese topics, it's closer to 16, and then mid-caps are around about 17 and a bit. So it's just a really interesting period, I think, where if you think back sort of 18 to 24 months ago, it was very much a story of the US economy is moving along very well. That's where the earnings growth is. That's where the Magnificent Seven are. And now I think you're seeing much more of a broadening, and particularly with the concerns around the capex spend in areas like AI, that's an interesting opportunity to diversify, and the cost of doing that is quite low.
Well, speaking of AI, do you feel as though that will continue to run? Obviously, with questions about valuations there, given what we've seen on Wall Street. How do you see that playing out?
Yeah, so I think it's an interesting period, isn't it? When you get a new piece of technology, there's kind of two things happening really, and there's the dynamics in the economy. And I think if you listen to the commentary from Chair Powell overnight, he noted that he's been quite surprised that you've seen 5 years of productivity growth in the US. And obviously there's probably a small part of that is being paid by AI, and maybe moving forward there'll be more. And then I think when you look at the actual financial markets away from the real economy, you're seeing a lot of volatility in the stocks. So Oracle, case in point overnight, that was a stock that ran very hard when it initially did the AI deal about 2 months ago. And then more recently, there's been a few more concerns. And then you've seen other stocks in the US markets that have done quite well. So the slower movers in terms of the AI phenomenon, like Apple, have had quite a good run over the last 6 months.
Marc, how do you view the private equity space? Because we've seen, particularly on the local market, slowly but surely they're picking off those listed companies here, aren't they?
Yeah, and I think that's the other dynamic, just to finish off on public equity markets, there's the declining supply. So I think that's interesting. In terms of private equity, I mean, I think you need to be very specific about the manager, and you need to be very specific about the vintage. But there's no doubt that you're starting to see more activity. And 2 days ago, you saw the CFO from Goldman Sachs say that basically they're going to have their second biggest year in history for M&A activity, so around about 1.5 trillion of deals that they've advised on. So there's a lot of activity there. And then I think as well you're seeing animal spirits stirring in terms of the venture capital space. So this morning there was an interesting article talking about all of the different companies that may list next year, and they're all companies that are worth over $100 billion, and the total amount that may come to market over the next year to 2 years could be in excess of sort of 2.6 trillion in valuation terms. So it's quite large. And you think the last time, if you look at where we had a pickup in the IPO window, having had a pretty stagnant period of time, that peak in 2021 was around about 460 billion.
So Marc, turning to Australia, now interest rate expectations, the narrative changed pretty quickly, didn't it? In the wake of inflation, so with potentially the next move being up next year, how then is that likely to affect the various asset classes here? What's your playbook?
Yeah, and so I think if you look at what's driving that, I mean, it's the productivity story. McKinsey did a big piece on sort of talking about why Australian productivity has been quite weak. And so I think that's obviously a big headwind, particularly in the backdrop of sort of increased fiscal spend and the consumer picking up a little bit with a high degree of sensitivity to a low move lower in interest rates. I think the challenge for Australian assets is when you look at them on a global stage, they're quite expensive. So if you look at the ASX 200, the PE ratio, even though it's started to come down a little bit, is still in that sort of top quartile that it's been in for the last 20 years. And the second thing I think that's happening is that you've seen relatively lower earnings expectations. And then I think what you've got to think about is the other asset classes. So bonds have now got a little bit more of a risk premium priced into them. The market's moving towards pricing 2 cuts. So I think given that sensitivity to the economy that I said on the way down in terms of interest rates, you'll probably find on the way up there's not a lot of room for the RBA to hike substantially, but it'll be a bit of a headwind. And then you'll have the knock-on effect to other asset classes that are linked quite highly to interest rates. And then I think the third thing that's really important to think about is the currency. And so when we look at the currency, think about those relative interest rates between the US and Australia. So I think where you're investing internationally, it's important to have a meaningful sort of hedge on some of those assets from a currency perspective.
You mentioned productivity, or perhaps the lack of it here in Australia. Interesting, we did hear from Jerome Powell off the back of the Fed decision, talking about AI being a catalyst for increased productivity. Is that likely to play out here, do you think?
Well, it's interesting in the US, isn't it? I mean, I think the flexibility of the labour market probably means that they have a little bit more of a first mover advantage, plus they're the centre of technology. But you would definitely think over time that it'll start to move in. So I think Australia is seen as someone who is a later adapter of AI, but will take time. And so it'll be interesting to watch. I mean, I think the problem is the lack of flexibility in our labour market potentially means that you're not going to have as much of an impact as you might have in an economy like the US.